Hey everyone, Emily Carter here. If you've ever tried picking a stock, you've definitely seen terms like growth stocks, value stocks, or dividend stocks. But what do these really mean? And what do they tell you as an investor? Today, we're comparing all three of them in a simple, practical way. And to make it even easier to understand, we're using three real examples: NVIDIA as a growth stock, JPMorgan as a value stock, and Procter Gamble as a dividend stock. Let's break it all down together. Let's start with growth stocks. These are companies expanding rapidly, often in innovative or high-tech industries. Instead of paying dividends, they reinvest most of their earnings to fuel even more growth. NVIDIA is a perfect example. Its technology powers artificial intelligence, machine learning, gaming, robotics, and massive data centers. Because the company continues to grow quickly, investors expect even bigger things ahead, and that expectation drives the stock price higher. The biggest advantage of growth stocks is their potential for high long-term returns. But they can be volatile, meaning the ride can get bumpy, so they're great for long-term investors who can handle short-term swings in exchange for bigger potential gains. Next, let's talk about value stocks. Value stocks are companies that have solid fundamentals, but trade at prices lower than what investors think they're truly worth. They don't aim to skyrocket overnight, but they grow steadily and consistently over time. JPMorgan Chase is a classic example. It's the biggest bank in the United States, with strong assets, reliable earnings, and decades of proven performance. Value investors look at companies like JPMorgan and say, "This should be priced higher than it is right now." Value stocks tend to be less volatile and more reasonably priced. They're perfect for investors who want stability and strong financial foundations. Now let's move on to dividend stocks. Dividend stocks are companies that regularly share part of their profits with investors in the form of cash payments. These businesses are usually stable, well-established, and less risky. Procter Gamble is an excellent example. It sells everyday essentials, things like shampoo, laundry detergent, and baby products. People buy these items no matter what's happening in the economy, which means the company's revenue stays steady. P&G is also a dividend aristocrat, meaning it has increased its dividend for more than 60 consecutive years. For anyone who wants reliable passive income, dividend stocks like P&G are incredibly attractive. So which one is better? Well, that depends entirely on your goals as an investor. If you want high long-term growth and don't mind short-term volatility, growth stocks might be the best fit. If you're looking for strong fundamentals and reasonable pricing, value stocks make sense. And if you want consistent passive income, dividend stocks are a great choice. Many investors use a mix of all three to balance risk, growth, and income in their portfolios. For example, an investor might put part of their portfolio into growth stocks, part into value stocks, and the rest into dividend stocks. This approach gives you exposure to innovation through growth stocks, stability through value stocks, and reliable income from dividend payers. It's a very balanced way to invest over the long term. So here's the core idea to take away from today's lesson. Growth stocks give you high potential returns, value stocks offer stability and strong fundamentals, and dividend stocks reward you with consistent passive income. Together, they create a powerful combination for long-term investing. In our next lesson, we'll look at the 11 sectors of the U.S. stock market, how each one works, which companies belong where, and how sector rotation can impact your returns. If you want to keep building your investing knowledge step by step, make sure to subscribe, and I'll see you in the next lesson.